Welcome. This is Dave Hardin with my co-host Kyle McCauley for the Einstein Retirement Workshop Retirement 360 podcast. Thanks so much for joining us today. We think we have a really interesting show for you. We're going to talk about moving in retirement, the plans to either move in retirement or what to consider, things that you need to think about. There's an article, I can't remember where it's from, but recently that more than 50% of people approaching retirement are considering moving to a different state, a different location in retirement. There are a lot of things to consider. You might think, oh, it's just easier, but lots of stuff to consider. Could be a great move, could be not necessarily a great move, but we're here to talk about that, and we want to dig in today, right, Kyle?
Yeah.
So first things first, what are some of the things that you've got to actually address? I want to tell our audience first off that we're not going to be able, there's too many states to dig in and explain which states are better, some are mixed. So we're not going to have that. You really need to talk to a retirement professional to deal with that. This is something that should be included in a retirement plan anytime you're doing that. But we are going to talk about general concerns and things you need to consider and look at, and some that you may not think about immediately. So Kyle, what are some of the things that we need to look at if we're thinking about, hey, maybe we're moving to Florida, maybe we're moving to Georgia, where we're going? What do we need to think about?
Well, I think the thing that you're really getting at is that most people, when they do retire, they are often thinking about trying to save on taxes.
Yeah, otherwise, absolutely. Big consideration.
We actually don't see tons of people moving outright. We'll see people pick up second homes, the snowbirding situation like we see here in Michigan. So that can be a big deal. But the big reason for the switch in many cases would be for tax savings. I would say, though, that it's not necessarily super straightforward. Just because, for example, a very common one that we would see is people in Michigan going to places like Florida. A shift from Michigan to Florida is not necessarily the right move in a total picture view, even though Florida has no state income tax. So there are some, if you're going to have two residents, switching your residence in Michigan, say to Florida, while it will save you on income tax, there are other ramifications to consider. One good example would be you'll lose your homestead in Michigan, and property taxes, depending on the county that you live in Michigan, it can vary pretty wildly. But if you're in one of the counties in Michigan that has a higher income tax, property tax, then losing that exemption could really affect you pretty significantly. And then also you have the issue of, if you ever do decide to sell your primary residence, say in the house that you've owned for 20, 30, 40 years, you could also potentially lose your exemption when you sell the home. That would save you on capital gains tax. So it is not a simple equation, but the big thing that comes to mind often is obviously going to be saving on taxes.
So I just want to make sure that we're making this as clear as possible, because I think you hit on something I hadn't even thought about, which is the homestead exemption. If you've kept the home here, but changed residence by moving to a second home in Florida or someplace else, if you simply change residence, you've lost your homestead.
Mm-hmm.
And
right.
And when you go to sell that house, if you've got 20 years of equity built into that house, you need that exemption oftentimes to cover those taxes. Well, you need it even if it's a small amount, but that just disappears on you.
That's just one. So you're focusing on the savings of the capital gains tax. The homestead exemption is the one that prevents the state or the county from increasing your property taxes.
Oh, yeah.
Right. So
this is the other consideration that you've got to plan for. The other one is that, and I know the straight move that you've got to consider is if you've been in a house for 20 years here, you're not really paying current taxes on it. You're paying, in Michigan, we have this law that prevents them from raising the taxes over a certain amount each year. But the the values have gone up significantly higher than that. So if I were to sell this house and buy a house somewhere else, I've got to consider that where I'm buying that house, I'm going to pay whatever the actual taxes are based on the actual value. It
Yeah.
could be significantly different.
Yeah. Just so, like, a great example of this would be generally we've seen price increases on average, or inflation in the housing market, depending on where you're at, average anywhere from 5 to 7%. Whereas you're going to have a inflation restriction on the tax increases, and that's going to be by law. Many states have this, not just Michigan, but many states have this type of restriction where the state or the county, even if the property values go up by 7%, maybe they can only increase the taxable value by 2%, let's say. And so if you lose that, all of a sudden they can increase it by that 7, 15, whatever the percent they deem that is reasonable. And I know you have gone back and forth with counties before. Am I right about that? Did I have that right?
Oh
Where
yeah,
you've contested, hey, wait a second, what do you mean my property went up, this amount? I don't
yeah,
think so.
yeah. Well, I came up with the idea. My wife actually executed it, but you can, here in Michigan, you can contest the amount that they're taxing you, and if you can give reasonable cause, usually in the form of an appraisal that says, hey, your value and the real value aren't the same thing. It goes to a panel. That panel is made up of an interesting group of people, but at least one of them is a taxpayer. They're usually on your side, and they vote. And if they vote correctly, and I've won this case at least once, where they reduce my taxes, and
Right.
that reduction doesn't just happen this year; it's extended for the rest of the time I own that property. So it could
Yeah,
be a lot of money.
yeah, because that next year's increase can only be based on the smaller
That's correct.
taxable value. Yeah, so losing that exemption can be a very big deal. And say saving on some income tax, and we help a lot of clients reduce their taxable income in retirement. I mean, that's I would say maybe that's one of our biggest demands from our
Yeah,
clients, is
absolutely.
helping them reduce their taxable income while still getting the amount that they want to enjoy. And so when we do that, going to a state with a more favorable income tax, but then losing an exemption like the homestead exemption in your state, that might more than what's what I'm looking for. It might cause your net total taxes, to go higher than if you had just stayed in your state and gotten your rental vacation home down in Florida or Arizona or wherever you wanted to go. So it is not cut and dry, although we do see many people relocating in retirement. I would say some exceptions to that obviously would be places with very high state income taxes. We have a fair number of clients in the New Jersey area. New Jersey has very high state income taxes. For those folks, a shift to Florida can really make a big difference. I mean, just a tremendous difference. We see people going from places like California to Nevada. That can make a huge difference. And so there are reasons to relocate for tax savings, because obviously, taxes, as we talk about all the time, and in our tax workshop we discuss, it's just an expense item on your cash flow worksheet. So when you're looking at your cash flow and you're trying to figure out, what do I need to spend in retirement, taxes is just a component of that. It's just part of that. So you have to be paying attention to that, because all that will do is cause you to spend more out of your assets. I did I think in the podcast yesterday, I talked about how if you make lots of mistakes with your income and in your taxes, and you enter that Social Security tax torpedo corridor, then that Social Security tax torpedo corridor, if you go into that, you could be losing as much as 50% uh, on your income in taxes for those dollars in that corridor. So a 2% withdrawal needs to be 4% to get you your net income. A 4% safe withdrawal needs to be 8% to get you to your net income in that threshold. So you just got to be mindful of those things.
You said, and I realize you didn't coin this, but you said it, and it occurred to me that it's really the point is the the net tax effect. It's everything combined together. It's not just taxes either, but taxes are a huge component of this. One of the things that's different that states treat differently is pension income and Social Security income, and it can be dramatic. Some states are very quick to give no exemption at all. Other states give huge exemptions for it, and you got to factor that in.
Yeah, so you have lots of different rules. You've got states like Illinois that currently do not tax those types of benefits, 401k withdrawals, pension benefits. What a wonderful deal. Then you've got other states like Colorado, which offer a very high standard deduction for the dollars coming out of 401k assets. So, like, your normal federal standard deduction is around $25,000. Whereas in Colorado, the state standard deduction for retirement income is $55,000. So it's, a really big deal, and it does make a big difference. And it does matter the type of income that you're generating. Just because you're retired, rental income doesn't become retirement income.
Right.
So it's still rental income. And so it's not going to get any of those special treatments. So then a state like a Florida, a Texas, Washington, these states with no state income tax could be helpful. But then you run into the secondary issue, which is, you still have to live in those states. So, you should compare your state's state income tax. You should compare the state's business taxes. Actually, you should look at as a consumer, because oftentimes the business taxes get passed on to the consumer. And so you'll see higher consumer goods prices in states that have higher business taxes. So the taxes find you one way or another. But again, I would say the exceptions where you can actually get some big savings are getting out of those states with very high income taxes. Just to pick on the two, the most fun to pick on, places like New Jersey and California are good examples of this.
The next thing that I think about is estate taxes, because if you have a sizable estate, their states treat how much you leave to the next generation very differently, and that can have a huge effect. I mean, there's a lot of people that have enough money that most of their estate isn't going to be income taxed if it's in qualified accounts, but it is going to be taxed as it's passed on. But the other tax, that estate tax of the actual estate that's passed on, can be huge.
Yeah, well, let me give a little bit more insight into the estate tax that is disappointing. I'll just say it that way. So the estate tax, two things. One, if you get hit with the estate tax in your state, Roth dollars. We talk to people a lot about doing Roth conversions and getting dollars out of their taxable accounts and into that tax-free bucket, that Roth IRA. But one of the issues with that is that if you are dealing with an estate tax, even federally, Roth dollars count towards your estate value. Did you know that?
I did not know that until this second. That's a huge deal.
Isn't that terrible?
It's criminal.
Yeah, well, right. Yeah, I mean, it's the rule anyway.
Yeah. I guess it's not a crime if the people that are doing it make the rules.
You could make an argument that all taxes are criminal under that thought process, but
let's not go there.
So, yes, they will. Estate taxes will hit even Roth accounts. So if you're doing some advanced tax planning, you're going out of your way to minimize your taxes, and you live in a state that still has an estate tax or a death tax, goodness, I don't want to say get out of there, but maybe you should really think about it.
Well, it's really, this is the point of retirement planning. So much, and I don't want to suggest that states are luring you in with bright shiny objects like low income tax and then hitting you with big estate taxes.
You're talking about Washington. You're talking about Washington. Washington has no state income tax, but has an estate tax. Yeah.
Yeah. Isn't it the largest in the country?
Yes.
I think it's, so.
Or at least it was last time I looked.
It's a pay me now or pay me later, or maybe it's a pay me now or pay me a lot later. You have to figure that out. You can't just assume that. The other, I don't know if we've covered this enough, but the other thing I think about is you can't take healthcare for granted either. There's a reason that the ACA is divided by states. It's because there are very different costs and there are very different insurance plans state by state. And healthcare costs can affect the amount that you pay for insurance. Now, you're going to pay the same amount for Medicare no matter what. But the supplement that you buy,
the Advantage plan.
Yeah. You can't just assume that it's going to be the same. And that adds up over long periods of time. It really adds up. So it's got to be a consideration as well.
Yeah, definitely. The other thing I would say about changing states is that unless you're in one of these sort of obvious states where it's just clearly better from a tax perspective, I will say this. I have we've talked about Monte Carlo before, the Monte Carlo test where you look at 1,000 trials, reasonable trials with all the different variables for a client's, retirement future. I have run Monte Carlo tests that had failure rates in their 1,000 trials. Technically, industry standard says you can have as much as a 25% failure rate, and that's considered okay. But I got to tell you, I don't have a single client that would be happy with that. A 25% failure rate. Yeah. But okay, so look, people want to get that 99%. I've taken people that are like at a 50% or a 40% success rate, meaning they have less than a 50% chance of making it through retirement without running out of money. Change the state that they're in. I won't pick on the states and say which state is which, but they change the state that they're in to a state with a lower income tax, and they get up to a 90% plus.
Wow.
So taxes is not nothing, okay? It's absolutely not nothing. You should really, retirement is about enjoying your life and enjoying the golden years. I know it's something you always say, Dave, is you were told all those years you were working that you get to retirement, those are the golden years. And when you get to those golden years, they should be golden, right? We want you to enjoy them and have a good time. And if you are living in a state that is a very high state income tax, but you're having the time of your life, okay, well, maybe that's the price you pay, right? Maybe that's what you need to do. But if it's not that big of a deal to you, and it can sort of make or break being able to retire at 55 instead of 65 to live in a more tax-friendly state, then I would say it's something absolutely worth considering.
Yeah, this is such an important process. It really is about what's better for you, what gives you that confidence that you're going to be safe no matter how long you live. That's really the question here, because the idea of growing old is bad enough, but to be old and broke, wow, that's just not something you want to have to deal with. And so this is really, really critical stuff that you got to get. And I know, we deal, because of the nature of our practice, we deal with virtually every state, and it makes this just part of what we do. But this is so important. I hear people all the time say, I don't have somebody that actually does my planning that deals with taxes, and I can't imagine doing a retirement plan and not dealing with taxes. It's just such an important thing, isn't it?
Well, when it comes to your tax planning, we did, just speaking personally and how we have modified our practice, we actually paid to develop a tax software that we felt we could actually use with clients to help them do some reasonable and high quality tax planning, because we do think it's very important. People have worked really hard for their savings to earn the pension benefits they have, to earn the Social Security benefits that they have. People work really hard in a long time. And the idea that we wouldn't help them coordinate these accounts, coordinate these assets, making sure that we manage their tax exposure over their lifetime, it just doesn't seem like the right thing to do. And as a as a firm that has fiduciary standing with clients, as a firm that is supposed to be putting our clients' interest ahead of ours, why would we take the typical route and say, oh, no, we don't do taxes? I mean, tax planning is not the most complicated thing in the world. We don't get into, hey, here's how you put a shell account in the Caymans. I mean, nothing crazy like that. But some basic and reasonable tax planning around strategies like Roth conversions, restructuring investment accounts to switch away from interest income into qualified dividends, which are get that special long-term capital gains tax treatment, or municipal bond interest income, which could be not taxed at all. Not looking at those options just seems like a huge mistake to us. So, yeah, I would say that looking at all of the range of options, doing what you can to minimize your taxes, it just makes a big difference. There's absolutely no two ways to say it.
Yeah, our company is structured, and I typically see almost everybody first to do what we call a retirement defender screener, which is we don't have time to go into that today, but I hear people all the time talk to me and say they sat down with their advisor, and their advisor said, "Don't worry about it, you're fine." The problem is the reason they're coming to us is because they still worry about it. They actually want to see that they're fine, not be told they're fine. And it's so important. You can't do that without doing the work, can you, Kyle?
Right. Yeah, no, you have to put a plan together in order to get people into position where you can actually see what is the net benefit. Anyone can convert some dollars out of an IRA into a Roth IRA, but does it actually make a difference? Does it work? You have to do the work to do that. And if you can't see it clearly, if you can't see how a structured plan doing things like Roth conversions, or a structured plan where you shift some assets that were generating interest income and you start generating different types of income, maybe more tax advantaged income. If you can't actually see the difference, I mean, it's really probably time to really start looking at an adjustment to how you're doing your planning, because you're not looking at it in a way that you can make an educated decision about. You're just guessing. We don't really like guesses in retirement. I think it's something that at Einstein, retirement workshops, that we really believe. That's why we do all of our educational workshops and all of our educational events. The reason why we do that is because we want to help people take the guesswork out of it. Guessing, you might as well hold your hand over your eyes and throw a dart at the dartboard. I mean, don't do that.
Yeah. Well, this is such an important topic when we talk about taxes, whether you're included in the moving in general, the things that surround itself. I know we didn't even talk about things like auto insurance, but there's a huge difference. Most people don't think about it, but Florida's not a cheap state for auto insurance. It's one of the most expensive. And if you have expensive cars, they can make a huge difference in your overall net outgo on an annual basis. And you got to consider that kind of stuff. Not that it's probably that's probably not the thing that would make you stand up and go, oh no, I'm not going to move to Florida. But you got to look at it. You shouldn't just, put the thumbnail up and say, oh, it looks okay, let's just do it.
The easy thing to look at is income tax. So that's a one-sided equation. If you're not a big spender, looking at income tax is probably a smart thing. But if you like to go out to eat a lot, you enjoy getting out there, spending money, doing things, that's then you got to deal with the sales tax. And generally, not always, but generally, states that have a very low income tax tend to have a higher sales tax. So you just have to be mindful of that sort of thing. And then there again, the one that's almost impossible to see without really digging in is the higher business tax, leading to higher consumer good prices in your state, the higher grocery bill.
Yeah. Is there anything else in terms of the move, the consideration for the move, that somebody ought to make a part of their planning process?
Well, one of the things that I am really starting to encourage our clients to do, as well as really anyone that we interact with, is to start getting some version of a virtual vault. Okay, we'll call it a vault or a folder, something that is, doesn't live in the basement of your house. And so by that, I mean, what am I talking about putting there? All your important documents, right? You need to put all your important documents in a space where if you're going to be moving, traveling, it's a good idea for you to be able to have access to these important documents and these important information pieces, regardless of your location. And then secondarily to that, a lot of people do have family that live in areas. And so if your relatives, loved ones, kids, if they are out of state and something were to happen to you, it's much better for you to have your documents available, accessible in more of a virtual way, rather than your kids having to hop on an airplane and fly to wherever your house is and go try to find the key or the passcode to that vault downstairs with all your important financial documents. Yeah, so I would say that would be another big transition point. That's a good idea whether you're moving or not, but it kind of gets emphasized, gets highlighted a little bit. We have clients that have we have a vault that clients can put important documents in, and we have clients that are uploading 20-year-old tax returns into this thing. And so they recognize the importance of having a secured place to store, again, their financial information. So if they ever need something, they don't have to worry about the house getting flooded, burning down, whatever it is. Although those people have everything in that fireproof box or whatever, the fireproof vault. So that would be another big thing that I would say is try to get your information available in such a way that you don't have to necessarily be tied to a specific location. It gives you some flexibility for lots of different reasons.
Kyle, and I'm going to I might go far afield, but I'll come back in 1 second. One of the things that I know is sort of thumbnailed in planning way more often than it should be, in fact, almost should never be, is how much am I going to spend on a monthly basis? And part of that is understanding these things. But many of the people, when I see people actually move, a lot of the time it's because kids or grandkids are there. And they're thinking, oh, I need $5,000 a month. And they're not thinking, what do I need if I move there? And that's such an important process, because if that number is wrong and you're doing your calculations are meaningless in the end, aren't they, Kyle?
Well, yeah, they could be, right. I mean, it could definitely throw things off. You want to take into account every variable. I mean, that's really what you're saying. Yeah. You got to take into account every variable. Otherwise, it could throw things off. I will say that, sometimes when we get into doing planning with folks, we'll get into the granularity of how much do you think you might spend on some travel? I don't know, maybe 10,000. Are you sure? 10,000? Is that the right number? Yeah, I think so. Well, what kinds of trips are we talking about? Well, we're thinking about taking a week in Europe. I don't think 10,000 is going to cover you. Maybe it will. Where are you going? And then they start describing it. No. You need 15,000 for that. That's a nice trip. You're probably going to want 10 days, aren't you? Not a week. Oh yeah, 10 days was what we were thinking. Okay. Yeah, so we have to sort of really take this stuff seriously, and it is important to start looking at it with some granularity, and then you can adjust things. If you're using a good retirement planning software tool, you can just dial things up, dial things back, and find where your budget is. So a lot of folks don't necessarily know how much they can spend, so that becomes another issue, because then they don't spend because they're afraid to. They're not confident that they can. And so just having a sense of what does my budget options look like? How much could I really spend? And then being able to dial that higher or lower and see the net effect over the coming years is a very big deal. It can give you a lot of freedom and confidence in these planning decisions.
I don't know what's worse, spending more than you should based on the amount of assets you have and what you're capable of spending safely, or not spending as much as you should or could. And realizing, 20 years from now that you could have done all these things, but you didn't because you didn't plan ahead. that would be boy, that's a sad story, and one that most people don't want to hear. So I totally agree with you. We're running out of time, and I wanna wrap up. Let you know that we appreciate you guys. We appreciate you listening to these podcasts. Please feel free to follow us to share. Again, I'll ask you if you have topics that you'd like us to dig into on Retirement 360. Please just list them. There isn't anything in retirement that we are unwilling to address or talk about and dig into. So please list your questions or topics. We'd love to deal with that. That being said, I'll sign off. Kyle, any last words?
No, have a safe and happy retirement. And if we interact with you more along the way, we hope to do that and hope this podcast adds value to your life and to your retirement future.
Thanks, and have a